Hi guys, this is Dean. Today we're going to look at the corporate credits tab on Koyfin. Before we start, I'd like to let you know that you can get 20% off Koyfin plans in the link in the description. Now this tab, corporate credits, is very interesting, and they've added actually a couple of features that are very advanced. I was very surprised when I saw this because to be honest, I didn't expect to be that professional at such a professional grade level, really. So what do we have? Or maybe we should start by explaining what are corporate credits or corporate bonds. Well, if you remember the previous video, we talked about government bonds and the yield curve and the global yields. Well, this is related because companies can issue bonds as well. Companies can make loans as well from, so traditionally we're used to think that when you make a loan, you would go to the bank and make a mortgage, right? Well, for a company like Apple, right, huge companies, they don't necessarily go to banks to make loans anymore. They can issue their own They issue their own corporate bonds, like an Apple bond, and issue it on the financial markets, and international investors can buy these bonds. And so the exact same dynamics apply, but here the issuers are corporations. Now, you can or you should look at this as a economic indicator. Even if you don't trade bonds, it's very important to see the bond market, because it can predict or influence in some aspects, in many aspects, the stock market, right? For example, if Apple issue bonds, right, they will have a yield, and this yield will be affected by market dynamics. It could go up or down. And if that yield gets unnecessarily high or out of control high, this will affect Apple's ability to borrow, and they will probably have problems in the near future because they cannot pay their obligations. Furthermore, if yields are going up in the bond market, maybe there is something that the bond market knows that the stock market doesn't know. You see, the bond market is worried about something that the stock investors did not foresee. So it's very important to look at the bond market as well, because it is highly connected to the stock market. Now, what do we have on this page? Well, we have groupings of corporate bonds. We have different sections here. The first one is US corporate high grade as filtered by maturity. So here in Koyfin, they have two main categories: US corporate high grade and US corporate high yield. Now, you may have heard this in a different name, which is more common. High grade is for investment grade, and high yield is for junk, okay? Junk bonds. And that's like these are the other definitions you may hear about. So high grade, they are high quality, essentially. So companies with pristine financials, well capitalized, well funded, no problem there, and they get high ratings from the credit rating agencies, so they are called investment grade or high grade. And the junk bonds or high yield, they have a poor quality, they have a poor score from the credit agencies, and so therefore you'll have high interest rates attached to these bonds, therefore high yield, and therefore junk bonds, because it's a bit of junk. Okay, so let's have a look at this here. We have, first of all, the high grade bonds by maturity. So we have the different maturities represented here on the chart. Now we have one thing that you should play around, which was not there on the other dashboards, is that there is 3 options at the top here, and I almost missed that, and this is amazing. Because, for example, here I have the total return. So here we're seeing the percentage return over 3 years. I could put it up for 10 years, why not? Or 1 year. So I have the percentage return, total return of these bonds, these groupings of different maturities. So for example, the plus 15 years has a return 21%. Then we have the 10 to 15 years, 17%. Then the 7 to 10 years, 16%, etc., etc. And then the last one is the 3-year at 8%. Now let's change that to effective yield. So this was the return of the bonds. If we change to effective yield, you can see the yield for each, okay, moving during that time period. So for example, the longest dated one was 5.42% yield, while the shorter dated one, 3-year, 4.66. So there's a tight spread here, but even tighter before that. And there's another option, which you can see the spread, the option adjusted spread. And you may say, oh, okay, what is that? Well, this is basically the yield minus the risk-free rate. And the risk-free rate is the government bond. So government bonds or treasury bonds are considered the safest financial instrument out there, right? Because the US government is not going to fail. It's not going to disappear next year or go bankrupt, quote unquote, of course. So we're looking at the spread between that bond, that corporate bond, and the risk-free rate, which is the treasury yield. So here, for example, if we look at the shorter dated one, we have 0.54%. That's the spread between the government bond of 3-year, 4.66%, and the government bond, the corporate bond, 4.66%. The government bond, if I go back to my yield curve there for the US treasuries, so the 3-year one was at 3.88%. So the difference between 4.66 and 3.88, that's the spread, okay? That's the difference. And so you can see the spread for each, the option adjusted spread for all the time frames, all the bonds, the effective yield of each, and the total return of each bond. That's really good. That's really good, by the way. Very impressed with Koyfin on this one. Let's go back to the 1 year and go down to the other categories. We have the groupings by rating. Not surprisingly, looks like the high grades. Oh no, look, the triple B bonds have outperformed the triple A bonds. So interesting dynamic here to see in the last 6 months. The triple B have outperformed, well, just a couple of percentage points, but yeah, we have the broad range, the triple A, the double A, the A, the triple B, and all of these categories are the tranche for investment grade, high grade. Let's go have a look at let's look at the effective yield quickly. Okay, between 4 and 5%. The spread with the treasuries. Okay, this one has really tight spreads. The AAA has a 0.32% premium over a government bond. So not a lot. Not a lot. It's basically almost considered as a government security at this point. High yield, the junk. Let's see. Ooh, triple C. We have a spread of 7.92. Okay, wow. Let's go back to the total return here, see how it did. Wow, went up 25% in the last year. Triple C bonds. We have the broad category at 16%. The B rated bonds plus 15.5. and the double B bonds plus 15.3. The effective yield on these, wow, triple C, we're looking at 11.82%. Just as a reminder, that means if you're a company and you want to issue bonds, but the credit rating agency gives you a score of triple C, you're categorized as a junk bond, and so the interest on this bond will be around 11.82%. Pretty high loan, if you ask me. And so that's why the option adjusted spread is so high, because 7.92 is basically the difference between the triple C yield and the government, the treasury yield. Now there are other sections which shows another interesting factor. So we have European corporations yield here, high yield, so junk, not so high. Oh, sorry, that's the spread. We have 3.3 spread. Total return 13%, pretty consistent rise. And the yield is 5.5. Okay, that's for Europe. Now, this is another interesting part. We have the geographical emerging markets corporate bonds. We have emerging markets broad, emerging markets investment grade, emerging market crossover, not sure, I would guess it's a mix of both, emerging markets high yield, Latin America emerging markets, EMEA, Europe, Middle East, Africa emerging markets, Asia emerging markets, Euro emerging markets, and again we can see the effective yield of each, total return, and the spread. Very good indeed. And then these are denominated in USD. Again, we have emerging markets, high grade, crossover, high yield, Asia, LATAM, EMEA. Guys, I invite you to have a look at this. As I said, it's a very powerful indicator to see how much it costs for companies to borrow money, right? And money is the blood of the business. So have a look at the tab, guys, and I'll see you in the next video.